You see, founders, those brilliant minds who kickstarted their own companies, often end up becoming dictators within their own organizations. And one such day was September the 16th, 1985, a day that marked a significant event in the tech world. Steve Jobs, the iconic co-founder of Apple, was shockingly fired from his own company. Can you believe that? It sounds totally unjust and unfair, right? Well, wait until you see the rest of them. There's this debate among Apple fans about whether it was right or wrong to kick out a founder from their own company. And let me tell you, it's a pretty interesting one. Now, on the surface, it seems unjust and unfair to strip a founder of their own creation. Morally speaking, we'd all agree that that's a bit of a low blow. Here's where things get interesting. In the case of Apple, it turned out to be a blessing in disguise. You see, after getting the boot, Steve Jobs had the chance to grow and evolve personally and professionally. Fast forward 12 long years, and Jobs made his triumphant return to Apple. And he did transform it. Under his guidance, Apple became the biggest company in the world. Jobs himself even admitted that getting fired was the wake-up call he desperately needed. It just goes to show that even the brightest minds can stumble and fall. Now, don't get me wrong, I'm not saying we should fire all founders and keep them grounded. That would be a bit extreme, don't you think? But what this story does illustrate is the importance of checks and balances. Having a system in place to keep those visionaries in check. In the good old days, large public companies had boards, chairpersons, shareholders, and executive teams to ensure balance and accountability. But alas, times have changed. Today, these structures are often just symbolic. The power lies firmly in the hands of the founders. Take Mark Zuckerberg, for example. Love him or hate him, the man has made some questionable decisions and launched a few flops. But does he lose sleep over being fired? No. Why? Well, because he owns a small percentage of Meta, his empire. Smart move, right? Modern founders have learned from history and become masters of retaining control. They've cleverly separated equity from voting power. Let's take Zuckerberg again. He may only own 13% of Meta, but he controls a whopping 54% of the voting power. Pretty sneaky. And it's not just Zuckerberg pulling these tricks. Google's Larry Page and Sergey Brin have a similar setup. Their combined stake is small, but they hold over 50% of the voting power. So despite their limited ownership, they wield absolute control over trillion-dollar companies with armies of employees, legions of investors, and billions of users. And that is how founders have abused their power and turned their companies into something similar to dictatorships. It's an old story, but it's also a cautionary tale. Now, what gives these founders so much power? It all comes down to the different classes of stock and their voting powers. Let me break it down for you. Companies like Google have different classes of stock listed on the public market. Let's take a look at Google, or should I say Alphabet Inc. When you search for Google on your brokerage, you might stumble upon Alphabet Inc. Class C shares. They seem pretty normal, right? But here's the thing. These shares lack voting power. If you want a say in the company's decisions, you need to get your hands on an Alphabet Inc. Class A share. They're almost identical to Class C shares, but they grant you one precious vote per share. But wait, there's more. The real power lies in Class B shares. They're like the golden ticket to the chocolate factory. Class B shares give you a whopping 10 votes per share. That sounds pretty sweet, doesn't it? Well, these special shares are usually reserved for founders, venture capital firms, and those in the know. You might be thinking, your one vote won't make a difference, right? Well, you're not entirely wrong. As an individual investor, your vote may seem like a drop in the ocean, but when those votes are concentrated in the hands of a select few, things start to get interesting. Multi-class stock structures like these were actually prohibited for more than 50 years. They were initially introduced to give founders more control over their companies when information wasn't as accessible as it is today. But over time, the founders got a little too power hungry. It started with just one extra vote, and then they pushed it to 5, 10, and even 20 extra votes. The trend took a dark turn during the 1920s. Everyday folks were flocking to the stock market, not just for voting rights or earnings reports, but for the pursuit of wealth, and companies took full advantage of this demand. They saw an opportunity to consolidate power and went all in. But there's one company that pushed the limits too far: Dodge Motor Company. In 1925, they had an infamous IPO, issuing shares with absolutely no voting power. Can you believe that? Insiders owned a mere 1.7% of the company, but had a whopping 100% control. I mean, this news actually shook Wall Street to its core. The uproar was so intense that the New York Stock Exchange had to step in. In 1926, they banned dual-class stock structures, putting an end to this madness. Well, at least for a while. But you know how it goes. History has a funny way of repeating itself. In 1971, something big happened. The birth of NASDAQ revolutionized the stock market with its electronic trading system. It was a game changer, but attracting investors wasn't easy. Traditional brokers still held sway, and even the NYSE adopted similar technology, posing a challenge to NASDAQ's advantage. But NASDAQ wasn't ready to throw in the towel just yet. In the early 1980s, they changed their strategy and focused on convincing companies to list exclusively on their exchange. They offered lower fees than the NYSE, hoping to entice businesses their way, but things didn't go exactly as planned. The American Stock Exchange, or AMEX, emerged as a successful competitor to the NYSE, throwing another twist into the mix. You see, the AMEX had a secret weapon up its sleeve: the policy on dual-class stocks, or DCS. It allowed for a voting ratio of up to 10-1, giving companies the ability to distinguish between ownership and voting power. But hold on. Meanwhile, the NASDAQ was always hungry for an advantage. They realized that DCS was their ticket to success. They didn't have any restrictions on dual-class stock to begin with, but now that they knew it was time to lean into it, they had two target markets in mind. First, tech companies were concerned that investors didn't truly understand the tech landscape, and second, companies that were vulnerable to corporate raiders. By separating ownership and voting power, they could shield themselves from these raiders. Can you feel that? The 1980s were a wild time for corporate raiding, and with the rise of tech stocks in the 90s, the NASDAQ skyrocketed alongside them. It was a match made in stock market heaven. Seeing this incredible growth, companies listed on the NYSE started threatening to switch to the NASDAQ if they didn't allow for DCS. They had no choice but to lift the ban in 1986. The tables had turned, and the game had changed. But let's not jump ahead just yet. In the early days, companies were relatively reasonable. Some notable NASDAQ players like Apple and Microsoft didn't even opt for dual-class shares. But as fate would have it, there's always someone who ruins it for everyone else. In this case, it was Google and Facebook. Fast forward to today, the dual-class stock structures have become the norm for most tech companies. It's like a secret pact hidden in plain sight. The average investor isn't even aware of it, and the practice has become so normalized that founders now have ultimate control over their companies. It's a tempting offer that many can't resist. I mean, if nobody's opposing it, why wouldn't you do it, right? It's not just limited to tech companies anymore. Legacy companies like Coca-Cola, Ford, Nike, Levi, and Hyatt Hotels have also joined the dual-class club. Even media giants like the New York Times, Fox News, CBS, and Comcast are in on the game. It's like a web of power woven throughout the corporate landscape. Alright, even though they're all enjoying it, there are some shining exceptions too. Take Amazon for example. Jeff Bezos might get some criticism for other practices, but dual-class stock isn't one of them. Another exception is Elon Musk and Tesla. In fact, this is why Elon was forced to relinquish his chairman position in 2018. And let's not forget Uber, a startup going against the trend and doing the right thing. I wouldn't say this is all gloomy and bad. The S&P 500, the heavyweight index, is putting up a fight. Starting in 2017, they made a ruling that companies with multi-class stock wouldn't be added to the index. It's a step in the right direction. And with index fund investing on the rise, newer companies will feel the pressure to change their ways if they want to be part of the big leagues. Anyways, keep aside the technical part. Do you realize how these founders were monopolizing voting power? Let us know in the comment section down below. And hey, drop a like if you want to see more videos like this. We'll be back. Until then, stay tuned.